So coming to the next one, IAS 38. So intangible assets. So first of all, what is meant by an asset? Asset is nothing but it is an economic resource controlled by the entity based on past events, which provides some economic benefits to the entity in future. So there must be a control and it must provide some economic benefits, future economic benefits to the entity, future economic benefits to the entity that is said to be about asset. So those assets are generally classified into the two types. One is tangible, another one is intangible. Coming to the intangible asset is nothing but it is an identifiable non-monetary asset without having any physical substance. So here it is an identifiable. If we have to identify it separately, it is an identifiable non-monetary asset without having any physical substance is said to be about intangible asset. So it must be a identifiable. Identify. So for recognizing the asset, we have to satisfy these conditions. So we have to consider these three factors. So the best example for intangibles are nothing but what? So patent, so technology or computer software, so trademarks and copyrights and formulas and goodwill, so franchise agreements, and these are all covered under what? Intangibles. These are all covered under what? Intangibles. So here we use the word identifiable. It is unidentifiable. So how can we say, how can we identify? How can we identify? Generally, we get the intangible assets in two ways. Either we can get it separately or it may be arised from the contractual obligations or through the other legal rights or through the other legal rights. So through the other legal rights, best example is, for example, A Limited. So A Limited purchased the business of B Limited, and actually the net assets of A Limited is around 10 lakh, but B Limited agreed to pay around 11 lakh. Then that excess amount 1 lakh paid is assumed as a what? Intangible asset, nothing but what? Goodwill. So in this way, and means in case of contractual or legal obligations, so it is arised as a part of purchasing the entire company. Purchasing the entire company. If it is a separable, the asset can be bought or sold separately from the rest of the business. From the rest of the business, like so we obtain what? Franchise is an intangible asset. So we obtain what? Patent, that is an intangible asset. So when we say it is a separable, if it is capable of being separated, if it is capable of being separated from the rest of the business, and it is capable of being sold, transferred, licensed, or rented, or exchanged either individually or along with related contracts or along with other assets, then we can say it as a separable in nature. And coming to the contractual, when it arises from the contractual or other legal rights, so then so if it is separable, the asset can be bought or sold separately from the rest of the business. In case of legal obligation or contractual rights, that will arise as a part of purchasing the entire company. This will be locked at future in the consolidated financial statements. Okay. So this is what. So as we already discussed, 3 points required to be considered. From the point of view of the intangible, we have to consider identifiable, and as a part of the asset, we have to consider controllability, and generate ability to generate future economic benefits to the entity. We have to consider these 3 points. Then coming to the recognition, coming to the recognition, there are 2 types of recognitions are there: initial recognition and subsequent recognition. Initially, so we can recognize the respected asset only if it meet the recognition criteria. So what is the recognition criteria? First, it has to satisfy the definition of an asset, and then it has to satisfy the definition of what? Intangible assets. Intangible asset. So that is nothing but what? It is an identifiable, a non-monetary item, and ability to provide some economic benefits to the entity in future, and it must be controlled by the entity. So if these conditions are satisfied, so generally coming to the asset criteria, it is able to generate future economic benefits, and the cost of the asset must be measured reliably. If these conditions are satisfied, so if it satisfies the definition of an intangible asset and ability to provide future economic benefits to the entity, and cost of the asset can be measured reliably, then if these conditions are satisfied, then we recognize the respected element as an intangible. So initially we recognize the intangible asset at what price? Cost. Initially we recognize intangible asset at what price? Cost. So means generally we recognize these elements for purchased good, purchased intangible. Generally intangibles, intangible assets, 2 types. One is purchased, and the another one is self-generated. So generally purchased elements are recorded at cost. Self-generated goodwill, self-generated intangibles are not recorded anywhere. Those are not recorded. So those are recorded at cost. Then after initial recognition, then coming to what? Subsequent recognition. So in case of subsequent recognition, we follow either cost model or revaluation model. Either cost model or revaluation model. In case of the cost model, how to recognize? We calculate cost less accumulated amortization. So just like a depreciation, but here we use the word amortization. Accumulated amortization expenses till the date is considered. This is the carrying amount. That is the carrying amount. Okay. So generally this method commonly followed. Commonly followed. So that is about what cost model. So intangible assets should be carried at cost less accumulated amortization and less any impairment loss effect. So impairment is nothing but what? Sudden decrease in the value of an asset, said to be impairment. So this is most commonly used. Amortization just like a depreciation. Remember, in case of amortization, generally we follow the straight line methodology. We follow the straight line method. So he clearly stated the intangible asset is amortized over the useful life, with an annual expense being shown in the statement of profit and loss each year. Just like a depreciation, we transfer the depreciation every year to the statement of profit and loss. In case of intangible, we transfer the amortization instead of a depreciation as per straight line method. So to the statement of profit and loss. And but this amortization is possible only in case of if the asset has finite use. In case of cost model, what is the book value of the asset? We said costless amortization minus impairment loss if any. But the amortization is possible only when the asset has a definite period. So say the corresponding intangible asset has a life of 5 years or 10 years, etc. Then we can calculate amortization expenses. Then we apply this one. For example, if the intangible assets are having indefinite useful life. In case of definite useful life, then book value is equal to cost less amortization minus impairment loss is considered. In case of indefinite useful life, then book value is equal to cost less impairment loss is considered, because no amortization is considered. in case of indefinite useful life. That is not possible because so while calculating amortization, generally we follow the straight line method. As per straight line method, what is the formula? Cost by useful life. Here, useful life is a definite or finite, then we can calculate amortization. If the useful life is infinite period, then how can we calculate the amortization? That is not possible, right? So that's why in case of intangible assets having indefinite useful life, amortization calculation is not possible. Just we calculate what is the impairment loss at the end of every year. Is there any indication for having the impairment relating to that intangible assets? Then coming to the revaluation model. Coming to the revaluation model. So in that case, in case of revaluation model, in case of revaluation model, at the end of the every year, first we calculate what is the fair value of intangible asset. What is the fair value? How to calculate the fair value? We took the fair value from the active market. We took the fair value from the active market available. Then that fair value is compared with the carrying amount of the respected intangible asset. Carrying amount of the respected intangible asset, and any increase or decrease in that intangible asset is a transfer to the statement of profit and loss. Statement of profit and loss. So, and in some cases, while calculating the fair value, the active market is not readily available. Active market is not readily available. In that case, how to consider? He clearly stated active market would include what? Item traded within the market or homogeneous, identical. We consider any market available for identical product and prices are available to the public. Okay. So in case of revaluation model, what happened here? The carrying amount is compared with fair value of the intangible asset. We show the intangible asset at fair value. Any difference arises is transferred to profit and loss statement. And coming to the internally generated intangible assets, as we already discussed. So generally intangibles two types. One is purchased intangible, another one is internally generated intangible. What is meant by internally generated intangible? For example, so if the last 5 years profits we considered 3 lakh, 15 lakh, 20 lakh, that these are our profit trends. So as the profits are in increasing trend, the business assumed that the number of customer base is increased, the sales volume is increased. So means the reputation for the company or reputation for the entity in the market is increased, and then company wants to generate that reputation in terms of what? Intangible, and those are called as what? Internally generated intangibles. Internally generated, but these cannot be capitalized. These cannot be capitalized because so in case of internally generated intangible, nothing was spent by the party. Nothing was spent by the party. So by way of paying the amount to the third person, then how can we recognize it as an asset in the books of account? Okay. So these are the best examples for internally generated goodwill. Internally generated intangibles, goodwill, brand, mastheads, and publishing with titles and customer lists, etc. And the accounting treatment for brand. Coming to the accounting treatment. So for creating the generally brand is covered under internally generated intangibles, but he clearly stated the expenditure on internally generated brand cannot be distinguished from the cost of developing the business as a whole, so should be written off as income. So as we already discussed, so internally generated intangibles cannot be shown, cannot be capitalized. We cannot consider it as a asset because the cost or amount spent for that intangible cannot be identified separately. If you able to identify it separately, then create it as an intangible, no problem. But here, while creating the brand, we did not spend separate amount for creating the brand as a part of the business process that was developed. So we cannot identify how much amount we spent on the generation of the brand. That's why we cannot create it separately a brand asset or because it is an internally generated item. So we have to consider it as an expense and transfer to P&L. Where the brand name is separately acquired, then we say it as what purchased brand. Then we can show it as a intangible asset and we show it under non-current asset as an intangible as per IAS 38. So purchased brand can be shown, but here we are talking about self-generated brand, we cannot be shown. Then goodwill. So as we already discussed, in case of goodwill also, internally generated goodwill cannot be shown. But purchased goodwill, if any, how purchased goodwill means what? As we discussed, A limited purchased B limited, the net assets are 10 lakh and the PC purchase consideration is 11 lakh. Here, the difference between PC and the net assets 7 lakh minus 10 lakh, 1 lakh is treated as a what? Goodwill. So this is called as what? Purchased goodwill. This is called as what? Purchased goodwill. So purchased goodwill, non-purchased goodwill. It is an inherent goodwill, cannot be identified, not recognized in financial statement, and we call it as what? Internally generated goodwill. But purchased goodwill can be shown. So purchased goodwill can be shown in the books of account. So as non-purchased goodwill cannot be recognized in financial statement. So coming to the research. So research and development. So research is a original and planned investigation undertaken with the prospect of gaining the new scientific knowledge and understanding. So for finding the new thing, whatever the performance, whatever the activity performed, that is called as what? A research. And the application of the research findings are covered under what? Development. Application of the research findings are covered under what? Development. Then generally research is a treat amount spent for research is a treated as a what? Expense and is transferred to statement of profit and loss. Then amount spent for development. Then we have to verify whether the respected activity performed related to development expenditure satisfy the conditions stated under pirate. So here, these are the pirate conditions. Then we treat it as intangible asset and is accounted as per IAS 38. Otherwise, that is treated as an expense and is transferred to statement of profit and loss. So we recognize intangible asset if and only if an entity demonstrate all of the following. So, so probable pirate means what? Probable flow of economic benefits from the asset, an intention to complete the intangible asset and use or sell it. There must be an intention to complete the intangible asset. Reliable measure of development cost. Reliable measure of development cost and adequate resources to complete the project and technical feasibility of completing the intangible asset so that it will be available for use or sale, expected to be profitable, that is cost of the project exceeded by the benefits generated. If these six conditions are satisfied, pirate conditions satisfied, then we consider that amount spent on development is treated as an intangible and is accounted as per IAS 38. If any one of the conditions is not satisfied, then those are treated as an expense and is transferred to statement of profit and loss. So the transfer to statement of profit and loss. Okay. So this is about what development expenditure. So in case of development expenditure, even if it is satisfy the pirate condition, so then development expenditure around 10 lakh, show it as an intangible in the balance sheet. Then it is allotted over the useful life. So how many years we are going to receive the benefits from the development expenditure over that period, this amount equally allotted and is subsequently transferred to P&L. Clearly stated. Development expenditure recognized an expense in profit and loss cannot be subsequently be restated as an asset. Subsequent period, we have to treat it as an expense and is written off by transferring to profit and loss statement by using the one process called as amortization. So amortized over its useful life as soon as commercial production begins. As soon as commercial production begins. Clear? Entity has incurred the following expenditure during the current year. So 1 lakh spent on initial designing of the work of the new product. It is anticipated that this design will be forwarded over the next 2-year period to be developed and tested with a view to production in 3 years' time. So then tell me, this 1 lakh amount is spent, is it treated as a research or it treated as a development expenditure? So this is treated as a what? Research and is transferred to statement of profit and loss directly because it is an initial stage of designing the work. Then 5 lakhs spent on the testing of the new production system which has been designed internally and which will be in operation during the following accounting year and the designing was completed. The new system should reduce the cost of production by 20%. So then this 5 lakh is treated as a what already in the process of already process is complete, designing is completed and is in process of operation. So we treated it as a what development cost. Development cost. So whether it is capitalized or will be transferred to profit and loss statement. So he clearly stated the new system will reduce the cost of production by 20%. So means it is going to provide the benefits by way of reduction of the cost in the future. So we treated it as a intangible asset and is shown as an intangible as per IAS 38. But the first one is a research and is transferred to P&L statement. Then second, the brand name relating to the specific range of chocolate bars purchasing 2 lakh. By the year end, the brand specialist had valued at this 2 lakh 50,000. 2 lakh 50,000. So generally, initially he purchased at our price 2 lakh. That is what initial recognition cost. Subsequent period, we may follow either a cost model, or we may follow what revaluation model. So, and coming to the revaluation model. So, in case of if you want to apply the revaluation model, you need to calculate what is the fair value of the expected asset. And the fair value is taken from the what active market. But coming to the brand, separate active market is available or not available? Not available. Generally for intangibles, active market is not available. So the evaluation is not applied. So we have to apply the cost model only. In case of cost model, we have to show the value at costless accumulated amortization minus impairment loss if any. Then we have to represent the respected intangible at a price less than the 2 lakh. 2 lakh minus amortization minus impairment loss if any. So showing it to 2,50,000 is not correct. Next. So 5 lakh spent on developing a new line of confectionery, including 1,50,000 spent on researching the project before management gave the approval to fully fund the project. So if 5 lakh relating to what R&D, research and development. So out of that 1,50,000, so 1,50,000 is spent on researching only. So that is a transfer to statement of profit and loss. And the remaining 3,50,000 is only treated as a development expenditure and it should be capitalized. Next. Training cost for staff use a new manufacturing process. The total training cost amounted to 1 lakh and staff expected to remain in for an average of 5 years. So generally trading cost is always treated as a general expense, operating expense, and is transferred to profit and loss statement. And is transferred to profit and loss statement. It is not covered under what intangibles. So Improve has a deferred development expenditure of 6 lakh relating to the development of a new Miracle brand X. It is expected that the demand for the product will stay at higher level of for the next 3 years. The annual sales 4 lakh, 3 lakh, 2 lakh units respectively are expected over this period. Brand X sells $10. So how should the development expenditure be amortized? So here the total 6 lakh is there. So the total 6 lakh is there. That 6 lakh total amount is a 6 lakh. Then how to amortize? We may follow either straight line method. Some cases here number of units obtained is specified. Then we may follow units production units method. In case of straight line method, 6 lakh by 3, so 2 lakh is said to be amortization expenses. But in case of units cost method, so that 6 lakh is allotted in the proportionate of number of units produced. That is nothing but what 4 lakh and 3 lakh and 2 lakh. That is nothing but what 9 lakh. For 9 lakh, the total amount is 6 lakh. Then it is allotted in the proportionate 6 lakh into 4 lakh by 9 lakh, 6 lakh into 3 lakh by 9 lakh, 6 lakh into 2 lakh by 9 lakh. This is the process of amortization. If you written off in the proportionate of based on the number of units or based on the total revenue generated. Okay, so this is about what intangibles.